Welcome to FRK 221. I'll be giving a short lecture on share capital, which is topic 3 from your module. I'll be making use of Test Your Knowledge of Accounting Part 2, which is your question book, from pages 74 to 82. This video will cover the aim and background of share capital. We'll look at the differences between ordinary and preference shares, changes in share capital, specifically ordinary share capital, and then we'll touch briefly on convertible debentures. The aim of this topic is to explain the shareholders' rights with regards to share capital. In the context of FRK 221, this topic is also very important for preparation for the next topic, which is IAS 33 earnings per share. There are two basic sources of funding for a business. You find the internal capital, which is your share capital, what we'll be covering in this topic. And according to accounting, this is the equity element. Then you also have the external capital. And the external capital is classified as a liability. The equity is the cash that belongs to the company, whereas the liability, the company has an obligation to pay that money back. When you look at the memorandum of incorporation of a company, you will see that the company will state the authorized share capital. The authorized share capital is the number of shares that the company is permitted to issue. The issued share capital is the number of shares that have actually been issued by the company to shareholders, and the unissued or reserved share capital is the number of shares that are authorized, permitted to be issued, but have not yet been issued. So, for example, if a company has 1,000 authorized shares and they've issued 100 shares, it means they have 900 reserve shares. It's important for a company to maintain a healthy balance in the unissued shares. Should they need to raise funds in the future, they do not want to deal with the administrative burden of increasing the authorized shares. There are two basic classes of shares that we will deal with in this topic. We will look at your preference shares and your ordinary shares. The ordinary shares represents the owners of the company. They are not guaranteed to receive a dividend, as ordinary dividends are dependent on the profitability, solvency, and liquidity of the company. Furthermore, they carry risk in that if the company should become insolvent, then they might not get their money back. They are the last ones to receive a payout. However, inasmuch as they are subordinate to all other classes of equity and all other debt instruments, they are important in that they make the decisions for the company. They have the voting rights. Your preference shares have preference over your ordinary shares. Your typical preference share, which is your cumulative preference share, accrues a fixed dividend on an annual basis, and this dividend is not dependent on the profitability, solvency, or liquidity of the company. So if a company cannot afford to pay or declare a dividend in year 1, in year 2, should they recover, they will first have to deal with the dividend from year 1 before they can pay the dividend for year 2. Preference shares are really popular for investors who are looking for a fixed source of income, as they provide a high degree of security. There are various types of preference share arrangements. I'll touch briefly on a few that will affect us in FRK 221. Your typical arrangement is your cumulative preference share. Cumulative, as I explained, means that the dividend accrues on an annual basis, irrespective of whether that dividend has been declared by the company. So you find cumulative or non-cumulative. Then you have your non-participating. Again, your typical preference share is generally non-participating. However, if you do have a participating preference share, it means this preference share receives a dividend which is fixed like all other preference shares. However, it also participates in the ordinary shareholders. So they basically receive two dividends. Then you have your non-convertible and your convertible. Again, your typical preference share is non-convertible. However, should you have a convertible preference share, that just means this preference share will be converted from one class of equity, which is preference shares, to another class, which is ordinary shares. And then finally, you have your irredeemable versus redeemable. Now, all of these that I've highlighted in blue, all of these generally constitute equity. So, if I talk about an irredeemable, it means the company does not have to buy these shares back. However, if you have your redeemable preference share, it actually no longer forms part of your equity. Generally, depending on the terms and conditions of those preference shares, if it is redeemable, you will find that it might possibly be classified as a liability. This information is sufficient for the purposes of understanding the next topic. When you process a journal entry when shares are issued, typically you will have a debit to bank, generally when shares are issued for cash. Then you'll have a credit to either your ordinary shares or a credit to your preference share, depending on which class of shares was issued. You do also make use of your share allotment account. That is before you finally issue the shares in your share capital account. There are various types of changes in share capital which do not give rise to an increase. The first of these is a conversion of shares, where you convert your preference shares into ordinary shares. Alternatively, you could also have a conversion of debt. Where, for example, you convert debentures, convertible debentures, into ordinary shares. At the date of conversion, there is no extra resources. The next type of share change is where you have a share split. Let us use an example. If you have one share worth 5 rands, then you split that share into 2 shares worth 2.50 each. You have changed the share capital structure. You now have 2 shares instead of 1. However, the total value of your share capital remains the same, which is 5 rands. A share consolidation is the opposite of a share split. We'll use this example. You now have 2 shares worth 5 rands each. So in total, the value of your shares is 10 rands for the 2 shares added together. You now take those 2 shares and you consolidate them into 1 share worth 10 rands. So you no longer have 2 shares, you now have 1 share, but the total value of your share capital has remained the same, which is 10 rands. The last type of share change is where you have a cap issue or a bonus issue. What happens here is that the company issues shares for free, but they issue these shares to existing shareholders. If the company is issuing shares for free, somebody has to pay for it. Well, the company is paying for it, and so they make use of their retained earnings account. What would happen in this case is you would debit retained earnings and there would be a credit to your ordinary share capital. Lastly, we're going to look at convertible debentures. When issuing debentures, the company generally recognizes a liability. That's the nature of a debenture. Debentures have a fixed repayment date, so the company has an obligation to repay that debenture, and debentures always carry a fixed interest rate, which is called the coupon rate. The interest on the debenture is recognized on an annual basis as finance cost in your statement of profit or loss. Debentures can also be converted into ordinary shares, and thereafter the debentures are no longer classified as a liability, but they are now classified as equity. When the conversion occurs, the company will no longer have an obligation to pay interest. They will also no longer have an obligation to repay the debt. However, the debenture holder, which is now the ordinary shareholder, might now receive dividends in the future, depending on which class of shares the debentures have been converted to. This concludes our video on share capital. I urge you to go through the pages that we have given you in your question book, Taste and Knowledge of Accounting, and make sure you understand the concepts that we address in this topic. Goodbye.